In the intricate tapestry of economic policy, few threads carry as much weight as the federal interest rates. Often simply referred to as the Fed rate, this crucial economic lever influences everything from consumer spending to global investments. But what are federal interest rates? How are they determined? And what ripple effects do they send through the economy? Let's delve into the world of Fed rates, exploring their significance, determination process, and broader implications. At its core, the federal interest rate is the interest rate at which depository institutions, like banks, lend reserve balances to other banks on an overnight basis. Managed by the Federal Reserve, often just called the Fed, this rate serves as a benchmark for other interest rates throughout the economy. The Federal Open Market Committee, FOMC, a component of the Federal Reserve, meets regularly to set the target range for the federal funds rate. Their decisions are based on a myriad of factors. Economic growth. If the economy is growing too fast, the FOMC might increase rates to prevent overheating and vice versa. Inflation. The FOMC uses the rate to control inflation. Higher rates can help reduce inflationary pressures by making borrowing more expensive. Employment. The dual mandate of the Fed is not just to control inflation, but also to ensure maximum employment. The interest rate can influence job growth and unemployment levels. Global events. Everything from global pandemics to international trade wars can influence the FOMC's decisions on the federal funds rate. The effects of changes in the federal interest rate are vast and varied. Consumer borrowing. When the Fed rate rises, borrowing costs for consumers often increase. This can affect everything from mortgage rates to credit card interest. Investment decisions. Higher interest rates can make borrowing more expensive for businesses, potentially slowing down investment in new projects or expansions. Stock market. The stock market often reacts to Fed rate changes. Generally, rate hikes can lead to declines, as higher borrowing costs can reduce corporate profits, while rate cuts might boost the market. Currency value. Higher interest rates can attract foreign capital looking for the best return, potentially increasing the value of a country's currency. Savings. For savers, higher interest rates can lead to better returns on savings accounts and other fixed income investments. Setting the perfect interest rate is a delicate balancing act. Unintended bubbles. Keeping rates too low for too long can lead to asset bubbles, where the prices of assets like real estate or stocks inflate beyond their true value. Income inequality. There's some debate about whether low interest rates exacerbate income inequality by disproportionately benefiting the wealthy, who are more likely to own stocks and other assets that appreciate in a low-rate environment. Global impacts. In our interconnected world, a change in the U.S. federal interest rate can have ramifications globally, affecting everything from international trade balances to emerging market economies. The federal interest rate, while just a number, is a powerful force in the economic landscape. Its careful calibration is essential for maintaining a balanced and robust economy. As consumers, investors, and citizens, understanding the dynamics of the Fed rate equips us with the knowledge to navigate the complex world of finance and economics more effectively.